lower inflation, rising capacity utilization, and congenial financial conditions continue to support domestic activity. The supportive monetary, regulatory, and fiscal policies, including robust government capital expenditure, should also boost demand. With sustained growth in construction and trade segments, the services sector is expected to remain buoyant in the coming months. Prospects of external demand, however, remain uncertain amidst ongoing tariff announcements and trade negotiations. The headwinds emanating from prolonged geopolitical tensions, though abated as I mentioned earlier, persisting global uncertainties, and volatility in global financial markets pose risks to the growth outlook. Taking all these factors into account, real GDP growth for 2025-26, the current year, is projected at 6.5%, our earlier projection, with Q1 at 6.5%, Q2 at 6.7%, Q3 at 6.6%, and Q4 at 6.3%. Real GDP growth for Q1 next year, 2026-27, is projected at 6.6%. The risks are evenly balanced. I will now speak on the domestic inflation. CPI headline inflation declined for the 8th consecutive month to a 77-month low of 2.1% in June. This was driven primarily by a sharp decline in food inflation, led by improved agricultural activity and various supply-side measures. Food inflation recorded its first negative print since February 2019. It was negative 0.2% in June. Double-digit deflation in vegetables and pulses drove this contraction. High-frequency price indicators signal a continuation of the lower price momentum in fruit prices to July, the last month as well. Fuel group inflation moderated over 2 successive months to record 2.6% in June. Core inflation, on the other hand, which remained within a narrow range of 4.1 to 4.2% during February to May this year, increased slightly to 4.4% in June, partly driven by continued increase in gold prices. The inflation outlook for 2025-26 has become more benign than expected in June. Large favorable base effects combined with steady progress of the southwest monsoon, healthy kharif sowing, adequate reservoir levels, and comfortable buffer stocks of food grains have contributed to this moderation. CPI inflation, however, is likely to edge up above 4% in Q4 of this year and beyond, as unfavorable base effects and demand-side factors from policy actions that we took a little while ago, a few months ago, come into play. Barring any major negative shock to input prices, core inflation is likely to remain moderately above 4% during the year. Weather-related shocks pose risks to inflation outlook. Considering all these factors, CPI inflation for the current year 2025-26 is now projected at 3.1%. This is down from 3.7% that we had earlier projected in June, with Q2 at 2.1%, Q3 at 3.1%, and Q4 at 4.4%. CPI inflation for Q1 next year, 2026-27, is projected at 4.9%. The risks are evenly balanced. I will now be speaking about the external sector. India's current account deficit CAD moderated to 0.6% of GDP last year in 24-25 from 0.7% of GDP in 2023-24. And I want to underline over here that it is not only in percentage terms as a proportion of GDP that it decreased by about 0.1% because of the expansion in GDP, but also because of a decrease in absolute terms of CAD by about $3 billion US dollars from $26 billion to $23 billion. And this is on account of robust services exports and strong remittances receipts. Despite a higher merchandise trade deficit, we have been recording, as you are aware, a high growth rate of about 17% in services exports in the last 4 years, and about 14% compounded annual growth rate of remittance receipts in the last 4 years ending 2024-25. This has made up more than for the higher merchandise trade deficit that we had last year. The merchandise trade deficit further widened in Q1 of 25-26. India's share in world services exports has risen markedly from about 2% in 2005 to 4.3% in 2024, driven by strong software and business services exports. Robust services exports coupled with strong remittance receipts are expected to keep the CAD within sustainable level even during the current financial year. On the external financing side, gross FDI to India remained strong during April to May 2025-26 this year. However, net FDI moderated during this period due to higher outward FDI. FPI inflows to emerging markets and economies have remained strong in May and June 2025. However, net FPI to India recorded outflows of 0.8 billion US dollars this year so far till July 31. This is mostly on account of outflows in the debt segment.